Hello and welcome to another episode of Darwin Investors. First of all, thanks a lot for anybody that's checking this channel back out, like people that used to check it out and you've come back. Definitely appreciate that. But today I want to get into it really quickly. I've got about two videos planned today. The first one's going to be an inflation rate forecast. We have an inflation print coming out on the 12th of December, a little bit later on this week. And then what we're going to do is kind of predict what we think that inflation rate's going to be. But we'll not only predict that one, we're going to look at January, February, March. We're kind of going to look ahead. And based on these inflation prints, I think we can more or less kind of like extrapolate what we think the interest rate's going to be. And right now, that's really important because if you can kind of predict interest rates, you can kind of predict market direction. It hasn't always been that way. You know, sometimes interest rates can go up and the market can go up too. But here, recently, it just seems like the direction of the market is very interest rate dependent. And so we're going to dive a little bit into that, get those numbers out there, and I'll tell you which way that I think that the market's going to go in. Then I'll also show you my own personal market moves that I've been making for, like, say, the past 5 months. And I could say that's basically been a combination of, say, laddering bonds. I've just been buying 1 month, 2 month, 3 month treasuries. I've been selling a lot of options, and I've been doing a lot of quick swing trades. And this is basically since about the middle of October. And then the second video, for anyone that's interested, I won't take it up in this video, but what I'll be doing is just for anyone that's interested, I'll do like a quick, like a short, like vloggy type video where I tell you where I've been, what I've been up to, why I've been dark, why I almost came back a few months ago, and then just kind of like dive into that sort of thing. And that's just for anybody that's interested. So let's go ahead and get into the interest rate and the inflation part of this video. All right, so in this day and age of like polarized politics, people are really only just kind of consuming the sort of news that sort of like confirms their beliefs. You know, it's like, is everything terrible? Is everything good? You know, we don't really, just depending on what your point of view is and what you choose to Google search or watch on television, that's going to like form your belief of the world around you with respect to, say, the economy or what have you. And it's not to say that there aren't people that aren't doing really well out there. It's not to say that there aren't people out there that are really hurting financially. These things are always going to be the case. But I'm going to just kind of give a rough overview based on economic data and facts of, you know, just numbers, which direction that this market is going to be going in, at least the one I believe that's going to be going in. And I'm going to just be basing this on math. So let's go ahead and start here first with this inflation release. And this is going to be coming out on, the CPI comes out on December 12th, which I believe is next Tuesday at 8:30 a.m. And we can see that, that over the past, you know, month over month, it goes 0.4 to 0.1 to 0.2, 0.2, 0.6, and so on. Where last month over month, it was 0.0%. We can see we have an annual 3.6 or 3.2% inflation print. We can see that energy has been well, it went down a lot last month. I can't imagine it's going up this month. It's actually, I think the price of gasoline has fallen for what, 60 days in a row, 70 days in a row, something like that. So the price of gasoline, despite what you're seeing in the news, is actually coming down. And so different things are actually coming down. So I would expect that this number is not going to be really big. I think month over month, maybe it goes up to 0.2 or something like that. But what we can do instead is we just kind of figure out that year over year, you know, we can expect probably 2.8%. That seems pretty conservative. We divide that by 12, and we can see that month over month, we would be somewhere between 0.2 and 0.3% month over month. Let's call this one 0.2. So when we go over here to the St. Louis Fed and we look at their year over year thing, what we can do is kind of figure out if something goes up 0.2, how much will that send it up when the inflation print comes out on December 12th? So before we can extrapolate that data, let's go ahead and look at how they do it like in the past. Let me just show you how this is done, and then we'll kind of be able to project to the future where the inflation rate will be, say, in the next 4 months or so, based on a 2.8% annual inflation print, right? So what they do is they take this number here, this 307.6, what is that, 19? And we divide that number by 1 year ago, which is what, 297.987. And you get this right here. You get this 3.2% that we're talking about year over year. So what we're going to do is trying to project out what we think it's going to be based on that annual reading of, like, say, 2.8%. So every month we'll say it's between 0.2 and 0.3 month on month. And the way we do that is we're going to do something like this. So we'll say, okay, what do we think it's going to be this month? Let's say this month it raises. It didn't seem like it went up that much, if at all, really. Let's call it 0.2 this month. So we'll say 307.619. And you multiply that by 1.002, and that will get us 308.234. And if you divide that number by this one here, which is 298.598, what we can expect is that this print at a 0.2% rise is going to be 3.2%. So I suspect that the inflation rate is not going to move at all. As a matter of fact, I don't think it's going to move at all year over year until we start going up this steep curve right here. And this would be your December, January, February months. So, but I would suspect that when the print comes out this week, there might be a little bit of, say, hey, people thinking that okay, so it's not coming back down. Inflation is sticky. The Fed's going to have to continue raising rates to get rid of this inflation, and some of that has to do with where the PCE, like the core inflation, is. Because for whatever reason, the Fed likes to trip out these things we never use, like food and energy, and they call that inflation. And so right now, that inflation is 4%, whereas the overall CPI with food and energy, those pesky little things that we never use involved, that is 3.2%. Now, if this number, this PCE number, continues to fall, let's say it goes down to 3.8%, even if this goes flat, we can expect that the market's going to respond in a very positive way. Even if this is flat, if this one comes down, people are going to be happy that the Fed's not actually going to raise. But I still think that even with 3.2, people think that the Fed is probably going to still pause. So let's go ahead and look ahead in the numbers here. So we went 0.2 in December. Let's call the next one after that 0.3, and the one after that 0.2, and then one after that, say, 0.3. So let's look at these numbers here and just kind of see where we think it's going to be. And I'm just kind of spitballing numbers out here. So we have the one that is this month times 1.002, and that would be for December. We multiply this one by 1.003, and we'll call that one January. And then January, we would expect that the number is going to divide that one by 298.990. And in January, we say that the inflation rate might actually tick up just a little bit. And this is going to alarm certain people, I suspect. But we're going to have this is going to alarm people. Hopefully PCE comes down if this one goes up, and this one I do suspect will go up in the month of January relative to December. But I don't know if it's going to spook markets as badly as it can, because we're going to have a counterweight to this bad news with when the bank earnings start in January. So when the earnings start pouring in and then they're okay, and this is showing that things aren't looking that good, I suspect that we're going to have a little bit of a counterweight and things are going to kind of level off. It may go down a little bit. People might be spooked a little bit. We had one month over month that didn't go down at all and one that actually went up. So maybe the Fed's going to have to hike up interest rates. But I think that with earnings coming through, especially when the big tech earnings start coming through at the end of January, it's going to have a little bit of a stabilizing effect on this increased inflation rate. So then we go ahead and look forward to, say, February, March, April, and what direction do we think it's going to go in then? So let's take this number here, 307.619 again, and we multiply that by the 0.2 that I was saying that might come up, right? And we multiply that one, that gets you to here, and then we multiply that one by 1.003, and this is the one I said would get us up to about 3.4%. Now we look at this month. Now we got a steeper curve here. Let's say that this time it goes up, say, 0.2. So we multiply this number by 1.002, and we get 309.777. All right, so that's going to be our February print of 309.777. We divide it by this number here, 300.536, and what we have here is a 3.1, so it's coming back down. So that's going to make the market a little bit happier. We're going to go from like 3.4 back to 3.1. And then for the month following that one, this is the one I'm really interested in here. Let's find out together what number that actually shows up to be. So that's December 0.003. Call that January times 1.002. Call that February times 1.003. Call that one March. That gives us our February number here. Let's divide it by our February number of 301.648 divided by 301.648, and we're going to be at 3%. Now, I'm not sure how the market will take this, because I know we're trying to get into that 2%. We want to get it down to 2. But I think that going from 3.4 to 3.0 is going to keep the market fairly stable. And I don't think that everybody's going to be thinking that the Fed's going to need to hike interest rates to tame this inflation or to cool this inflation. Not at this point. So what are some of the other economic like data type stuff coming in that we can look at to kind of help us kind of predict which direction that we believe the market will be going? And I believe that the inflation will be 3.0 in February. Someone will point out that that's what it was in October. It hasn't budged. It's been very sticky, and that's going to be true. But earnings are going to come through, and they're going to come through, I predict, very strong yet again. So let's go ahead and look at some of the data that's coming in with respect to earnings in the S&P 500, inflation on certain things, and basically wage increases. And so we'll see if there's a reason to think that the market might actually be stabilizing. So when we look at the change in S&P 500 year-over-year earnings, you can see that we were in free fall here from Q1 of 2022 all the way through Q2 of 2023. So what we experienced in 2022 with the market coming down like say 20% or what have you, whatever that was, what we experienced was this. It was this like the market had it right. They were looking at company earnings, and they were showing that it was in rapid decline. And so what I'm looking at right here, when I see this right here, what I see is a recession. And that's why the market did what it did, is because we had our recession, as far as I'm concerned, based on year-over-year earnings in the S&P 500. We had our recession in 2022, and that is why the market went down. Now, why is the market going up this year? Well, it's predicting that we're going to be pulling out of this. And like last quarter, we were up, 5.6%. GDP was 5.2%. Like, we're pulling out of this recession that we had last year. And I think that that's going to cause the market to, stabilize here going forward, as I don't believe we're in the recession. I think we're getting into a more of a normal economy at this point, something that we might have been used to for the majority of, say, the last 30 years or so. So but a lot of people are still, and understandably so, affected by inflation. They're upset by it and everything like that. Plants have gone up 21%, natural gas up 29%. Cars are up 35%, groceries up 25%, restaurant up 24%, rents are up 20%, and so on and so forth. But when you look at, you compare that to the amount of wage increases that we've had, right? So we had a 20% wage increase on average across all, say, income levels. Of an increase of 20%. So if we go back to this, based on the fact that we went up 20%, we're only down a little on indoor plants, we're down quite a bit on natural gas and car insurance, but major appliances are cheaper than they used to be, groceries a little bit more expensive, and so on. Rents are about the same, water and pets are cheaper, or what have you. But the thing that I think is really interesting here is that our real income across all sectors is actually up 0.6%. And I think that ideally what you want this real income to be is actually flat. I don't think you want it to go up or down. What you're trying to do is avoid that wage price spiral where this real income is through the roof. So this nominal needs to go way up because we've got to pay all these wages. I think that real income right around zero is actually the sweet spot for the Fed. We don't want to see this thing just go up. We don't want to see it go down, but we don't want to see it go up either. We right around zero is the sweet spot. But actually, if you really want to make the economy kind of a little bit hot, make it a little above zero. And that's exactly what we've been seeing here when we look at, say, Black Friday sales with a record high spending. You may say that's because of inflation, and it might be, but it's also because people have jobs and people have money and they're spending money. So for that, we have a record $9.8 billion in sales on Black Friday. We also saw record holiday travel this year. And again, it's because people have money and people have jobs, and the economy is kind of hitting its stride. It seems to be kind of like normalizing. We went through our recession and we're kind of pulling through it on the other end right now, or at least that's what it appears to me. Inflation looks like it's going to be stabilizing and that sort of thing. It's not going to come down to that 2% level that the Fed is kind of hoping for. It might spook some investors, but we're going to have some earnings that I think are going to back up the fact that we should still be going up a little bit on the in the stock market, as after all, the stock market is a reflection of S&P earnings. That is what it is. It's a mirror of S&P earnings. That's what the stock market does. And we're going to show, and the earnings that are going to be rolling in here in January again are going to show that earnings are going to be all right. And the fact that we don't have a wage price spiral and things are kind of normalizing, what I would expect is we're going to see more of a normal stock market in the coming year. And so in the normal stock market will actually return about 10% every year. What would I say? The average analyzed return is 9.81%. So what we can say is that at the end of the year next year, that if this goes up 10%, we'll be at roughly 5,100, 5,200. And I think that's a safe spot to predict the end of the year of 2024, because I see that this as the year normal. I know that we have a presidential election and everybody's going to be spooked and everything like that. But what I see in the year coming up, it's going to be more of a normalized year. Does that mean that tech's going to outperform this year? I think it will, but without being too wishy-washy. I know that they're going to say it's going to be a catch-up trade. Maybe it's going to be financials. Maybe it's going to be industrials, or what have you. Definitely not going to be utilities, not with higher interest rates. Probably not going to be consumer staples, not with higher interest rates. But I do think that we're going to have the year of normal. Is this the year that we maybe start considering some housing stocks, your Whirlpools, your Lowe's, Home Depots, and that sort of thing? Maybe. I mean, because remember, the stock market, like when we showed this graphic right here, with the way the stock market was like getting slammed, even though earnings were still positive, because it was looking ahead to something awful. Maybe in the same way, what you'll end up with is a stock market that looks at housing as something. We're not looking at 2024. We're looking at 2025. We're looking at rate cuts. People are going to be able to move again, and that sort of thing. And maybe that's why people feel really bad also about the state of the economy, is the fact that they seem so tied to their home, and the interest rates are high, and they can't buy a car, and they can't sell their house. And like these are the things that generally make people feel bad about the economy. But you can see from the numbers that things are actually humming along all right. And I would consider today's economy fairly pedestrian, just normal. It's not good, not bad. It's normal. Normal good, actually, because of the low unemployment rate, but just fairly normal. So let's go ahead and dig into what I've been doing for the past 5 months or so. So we're going to go through my, like a lot of the transactions I've had. It looks like here since about July or so. I'll skip through this because my name pops up in there, and I know you wouldn't actually like hunt me down and steal money, but you never know about other people. So I'll go ahead and kind of like skip through this and kind of look to see where my mind has been for like, at least since July or so. So you can see I was like selling a lot of options on my underlying holdings, and they were almost all energy. I had ConocoPhillips, Chevron, Phillips 66, Marathon, Target. I don't even remember having Target. Okay, Bank of America, Coupang I bought, and this is a funny one. I bought Coupang. I buy this stock because, basically I keep a very small position of Coupang because I always think to myself, it's the one that I think is going to go to the moon. And so I don't bet heavily in it, but I do tend to buy a little bits of Coupang every now and again because it's basically South Korean Amazon. I might do another video about that one. Looks like I was buying or selling call options on Bank of America, so I must have owned that. I'm a little surprised that I own Target. I wonder how I did on Target. I forgot I even bought that one. You know what I was probably thinking is I think there was some sort of conspiracy or some sort of like cancel culture sort of thing about Target. And I tend to I gravitate towards these types of stocks that are getting like canceled in in the mainstream media, and that might have been why I went into this one. Because one time I made a lot of money on Wayfair because apparently I think it was George Soros or Hillary Clinton or someone was like supposedly smuggling children in cabinets and then carefully labeling these cabinets with the children's names to send them off to different people that were going to traffic them or something like that. And I thought, well, that is the stupidest thing I've ever seen. Or ever heard of anyway. And and that crashed the stock price. I was like, well, I'm going to buy some of that. And then it turned out that, believe it or not, that wasn't true. And and then the price went way up and made a fortune on Wayfair. Just you can use these conspiracy theories. Some people like get all mad, but I just try to profit from these dumb things. But Target was one of these. I think this was one that was being canceled because of. I want to say it had something to do with some sort of gay pride line or something like that. And then I read into the thing that said what it was, and I was like reading these bathing suits, and it was like these bathing suits that you tuck in, and I was like, well, the tuck in bathing suit, that doesn't make any sense. That's really weird. Like, who tucks in their bathing suit? Then I saw what they were tucking in, and I thought, oh my gosh, that is diabolical. No one should go to the beach and do that sort of thing. But anyway, I was toying with Target because I thought it was basically being targeted for, well, no pun intended, for being like basically like canceled. And so it looks like I was playing with that one. All right. So anyway, that takes care of that. And a lot more again on the oil companies. Another one here on Target again. And it looks like I ended up buying Target. I must have gotten what I did with Target. Let me just check that one out because I don't remember buying it. So it looks like in my lifetime, then what I don't remember. I don't remember ever owning Target, but it looks like I bought it for $135.98, but sold it for $135.68 for a net loss of $30.12. But of course, every time I buy something, I sell options on it, and I don't need the stock to go up to make money. So let's just go ahead and see if I made anything or lost anything on Target. I was down $30. My God, I did a lot of stuff with Target. So I ended up making $700 with Target. So I bought it for less than what I sold it for, but still made $700. And that's just kind of the way that I work this market. I don't need a stock to go up to make money with it. I just buy it and then sell options on it. Apparently, in the case of Target, I don't remember this, a lot of options on it, but I ended up making about $700 on that one. But I digress. Let's go back to my portfolio here, and we'll see what I've been doing for the last, say, few months or whatever. So carrying on with July here, we can see that I was still like trading options, selling calls on all my oil companies, Target, Bank of America, which I don't remember owning, or selling options on Coupon, which I tend to buy whenever I get a little bit of extra money, like I said before. Again, selling more options on my oil companies. Amazon, I do remember this one. This was the one where I wanted in on this one. I just went ahead and bought it because the thing was this Lena Khan, I think that's her name. She was like declaring some sort of war on Amazon, that they're a monopoly. And I'm like, a monopoly? Monopolies don't have a million competitors the way Amazon does. Nevertheless, the government's saying that Amazon's a monopoly, and I don't see it. And because I couldn't see it along the lines of Target and kind of goofiness, I went ahead and bought Amazon also because of goofiness, and selling even more calls on oil stocks until we get here to August 4th. On August 4th, what I ended up doing was I thought, okay, this is the end. I think this is as high as oil can go. So I sold all of my stocks up to and including Amazon. Looks like I sold Amazon for 141, Bank of America, I guess I owned it for $31. Apparently I did, for $31. I sold ConocoPhillips for 114, Marathon for 138, Phillips for 110, and Chevron for 160. And then I just started laddering bonds. I bought 1 month, 2 month, 3 month treasuries. I call the guy over there at Charles Schwab and he says, well, we really don't encourage timing the market. And I said to him, well, look, I've run the numbers on inflation for the upcoming months. I think the market's going to go through a rough patch here until the middle of October, when JP Morgan and the Citibank and Wells start like reporting their numbers and showing that things are okay. But between now being August 4th and like October 13th, we're not going to see any good news. All it's going to be is that the inflation rate's going to go up and the Fed's going to have to continue hiking rates. And that's exactly what happened, actually. So I ended up like buying a bunch of treasuries, and as the stock market went down, I was fine. I sold out, bought treasuries, and I was actually going up, and it was steady, and it felt really good. And it was really relaxing every day to know that every day the government was paying whatever, $50 a month just for me to sleep or whatever. Or they weren't paying me $50 a month, whatever. It was $50 a day. It was like something like $1,300 a month. Just on these things. So you can see I just went heavy into treasuries, and this would have been on August 9th. And these ones mature on August 29th. These ones September 26th. These ones October 26th. So I'm just buying all these bonds. I moved more money into the account from some other account, and I decided, you know what, I'm just going to manage it this way. I think this is a fun way to go about it. And then right now I'll just ladder bonds, and then I'm going to wait for an opportune moment. And that moment's actually going to come in the middle of October, just before the banks start declaring earnings. So I'm buying all these treasuries, and then all of a sudden here at the beginning of October, I'm noticing that we're getting kind of close to my spot here, which is the middle of October. And that's when the earnings are going to come in. I'm like, really, I need to start thinking about getting in. It looks like I was trying to get in on Amazon. And that is interesting. I don't remember having this much Amazon activity. Lena Khan must have been on fire at this time, and I just thought, this is a travesty. I'm going to go ahead and buy. Let me see how I did on Amazon. I don't even remember. So it looks like with Amazon, I ended up buying them on October 20th. I must have sold a put and got settled, and I got that for $130. And then owned the shares on the 23rd, and then sold them on the 26th for a $980 loss. If I include my options, let me just see how I did here. So if I include my options, it looks like instead of a $980 loss, I actually made $390 on Amazon. I think they're like 145, 140. I probably should just held them. This is one of the downsides of the stuff that I do with Amazon or with any stock, is that sometimes it's better just to hold on to things. And I'll demonstrate that a little bit later here in this video, because man, I nailed one, and I should have just held on to it. And I'll show you what that one was. And that one, if you could tell, was this one right here. It's NVIDIA. I ended up buying 100 shares of NVIDIA for $393. And again, this is the end of October. If you look at the S&P at the end of October, you can see that I was buying these things at a time when the market was quite down. It hadn't yet ripped, right? And so, but I think it's going to rip, but it just hadn't quite done it. And I was expecting it to start like stabilizing right around this time here, when earnings come in, kind of cross. I'm like, God, these earnings are coming in. This is not working out the way I thought it would. I thought it would go trade sideways, but it just kept on going down. But nevertheless, I look at NVIDIA. I see this company at 26 times forward earnings. I see a company that's 30% year-on-year annual growth that's projected for the next few years. One that already grew over 200% last year. It's trading almost at a market multiple. And this thing is, I don't understand why a company that is growing like that can actually be trading near a market multiple. Why is it not $700 a share? Why is it not like Broadcom at 800, 900, or even Chipotle at 2,000? Who knows? But why is it sitting here at 400, or in this case, 393? And so I just can't wrap my head around it. So I'm like looking at NVIDIA, and I'm thinking to myself, this is the stock to own. And the only reason I can come up with why it hasn't surged more is because it's already up 220% last year. So people can't justify it going even higher, even though I don't see how it can't go higher. So anyway, I bought it here at 393, and then I sold it at 396. And so I made a few $100 there. I see and then AMD was going to report earnings. I bought them at 98 and sold them, I think, at about 102 or something like that. bought a little bit more coupon. AMD, I see them as the poor man's Nvidia, but if someone's going to take market share from Nvidia, I think it's going to be AMD, and I bought them on October 31st and sold them a few days later. Looks like I sold them on November 1st for 102. And so, again, bought a little bit more coupon, more treasuries. Looks like I bought, more treasuries. Sold put on JP Morgan, just don't know why, but did. Again, more Amazon. And from there, the theme is NVIDIA and treasuries. And it's NVIDIA, and that basically just takes us up to today. And then I think it was a couple days ago, AMD says something along the lines of, well, we got this new chip. It's better than NVIDIA's chip, and it's going to take over their H1300 at databases and all this sort of thing. It's the new AI chip. It's better. It's faster. What do we know about this AMD-NVIDIA relationship? Here's what we know. That AMD is always chasing NVIDIA. And so the fact that they have reported this new chip that's going to be better than NVIDIA's chip, what do we really think NVIDIA is going to do in the next couple of months? They're going to put out the next biggest thing for AMD to go and try and chase. And so for me, I'm kind of in on NVIDIA right now, and I don't mind this AMD news stepping on their toes a little bit like that. And what else do we expect? What do we expect from the Fed? Well, just like we know what happens in this relationship between AMD and NVIDIA, we also know what to expect from the Fed. It's like sort of like when my wife says I'm going to be someplace at noon. She doesn't usually show up till, I don't know, 12:30, 1 o'clock. You know that she's always going to be late. And that's the same with the Fed. We know they're going to be late. Everybody's saying, oh, they're going to cut in March because inflation's coming down. No, they're not. They're just late to the party. That's just what they do. So I wouldn't expect them to be cutting rates. And if they do cut rates, it's not going to be anytime soon. And not only that, I can't even think of why we would cut rates. Why cut rates right this second when things seem to be humming along in a normal economy just right now? Like, why would they do it? The only thing I can come up with is maybe for political reasons, or maybe for some political pressure to try and cut rates so that normal people can go off and buy houses again and at least feel like the economy is humming along the way it is right now. But I don't see a reason apart from like a full-blown recession hitting the economy. Why, if it's humming along okay, why would the Fed cut rates if it's not political? I just don't know why they would do that. And do I think that the stocks are in a bubble right now? I do not think the stocks are in a bubble right now, because a bubble can be loosely defined as something that happens to the stock market if stocks go up and you don't own them. Then you get on CNBC and you say, hey, we're in a bubble right now. And as far as what I'm invested in, I'm basically just all in NVIDIA. I just play NVIDIA, and I love NVIDIA because it's got such high volatility. And so I think I bought it at 45 and 469. But my cost basis on NVIDIA is something like 455 or something like that. And this is only the last little bit because I keep selling options against NVIDIA, and it just pays me really good. So I like the volatility of NVIDIA. I like the valuation of NVIDIA. And I just think relative to other stocks, it's kind of like the cheapest, best deal in the stock market. And the way that I trade stocks, all I need is bonds and just that stock, and I can play the stock market. I only need to play the stock market with one stock. I even made, looks like, money off of Target, and I made money off of Amazon, even though I sold it at a $900 loss. Made money on Amazon, and then my biggest mistake was actually buying NVIDIA. It looks like at 393, looked like I had 100 shares there, and then selling it at 396. So I'm gonna be holding on to NVIDIA. I'm gonna do it with something that's totally against my nature. I'm just gonna hold it. I'm gonna see what happens, because I think, now this is my gamble, I think NVIDIA goes to 1,000 before it goes to 300. That's my prediction for NVIDIA. I think it's going to go way up. I think the fair value for NVIDIA is roughly $700. I think it's going to go way up before it goes down, but it may go down, but I'll just sell calls along the way and just get my money back that way. And then as some of my bonds mature, if NVIDIA comes down, I'm just going to buy more NVIDIA. I'm just going to keep on doing that. All right, well, so if you got anything on this video, please like, subscribe. Thanks for coming back to this channel, and then hit that little notification bell. Until next time, we'll see you then. Have a great day. Bye.